out of a total of a bit less than 200,000 tons of above ground gold stocks. China has cornered the gold market. That's what it boils down to. Because it's not just China. You've got India, which has got massive amounts of bullion held in the form of jewelry. I mean, most of the Chinese public gold is actually jewelry as well. And you've also got Russia. Now, I understand on pretty good authority that Russia's got two sovereign wealth funds, which have a total of about 10,000 tons of gold between them. And then you've got the Russian Central Bank, which has got a further, 2.3 thousand tons, whatever. You've also got the whole of the Shanghai Cooperation Organization and BRICS, all their central banks. Presumably they've got sovereign wealth funds as well.
Alasdair Macleod has been warning about the significant changes taking place in the world gold market for years. Macleod claims that there is a steady challenge to the Western nations' long-standing hegemony over gold reserves and market management. The US and Europe controlled gold trading, pricing, and policy for many years. According to Macleod, this is a fundamental shift with significant ramifications for investors, not just a small adjustment. Asian central banks are strategically lowering their reliance on Western financial dominance by purchasing gold, not only to increase their reserves. As pressure mounts on the US dollar's status as the world's reserve currency, nations such as China are turning to gold to bolster their economic independence while also looking into other options for international trade. Macleod also notes that this shift is reflected in trading patterns. Western exchanges no longer hold exclusive influence over gold pricing. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing.
Yeah, well, I think your friend who took his profits $1,000 below this, you'll probably power back in over 20,000 sometime. I don't know. That's what tends to happen. I mean, I speak as as a stockbroker of some decades, knowing the human behavior, if you like, of investors and speculators and so on and so forth. And there is absolutely no doubt. I mean, the sensible advice to an investor is when you've got a nice profit like that, book some of it and just run the rest for free. As for overbought, no, it's not. If you just look at the open interest on COMEX, there's no way it's overbought. I mean, the amazing thing is that most of this rise, both in gold and silver, has been on the back of a bear squeeze, not, enthusiastic buyers rushing in and buying it. And there's a complete misunderstanding actually about what gold is about. I mean, there are enough gold bugs running around saying, oh, it's going to the moon, or it's going to do this, going to do that. But actually, do they really know what they're talking about? I mean, they tend to look at charts, let's face it. And they've also got this thing in their brains about, government is wicked and therefore gold is good. It's not good enough, actually. You've got to really understand what the game is about. The point is that, it goes back all the way to Roman times. They decided the difference between final settlement and deferred settlement was final settlement was settlement in something without counterparty risk, and that was metallic. And when they produced the first Roman laws were dated in 448 BC. They said settlement is metallic. In those days, it was a pound of bronze, basically. That was the unit called the ice. And gold came later, of course, because it's a lot more convenient and so on. And it was also being discovered a bit more. So, there was a little bit of quantity there. So it could be used for the temporary storage of one's labor, if you want to really sort of go back to classical economics. But otherwise, everything else is deferred settlement. It's a promise. It's a promise to pay. You might think that you're paying a workman for painting outside of your house. And, okay, fine, you paid him. But there's not final settlement, because what you've done is you've done a probably cash, in which case it's the counterparty risk is actually with the central bank, or alternatively, by bank transfer. In other words, you've just transferred one form of deferred settlement for another. Nobody does final settlement nowadays. But when you get a loss of confidence in the value of the currency, which is the top level of credit, if you like, in any economy, then that loss of confidence is reflected in a falling value for the currency. And that is exactly what's going on. So the idea that gold is overbought, oversold is rubbish. It's got nothing to do with it. Really, what we're looking at is the relationship between gold and fiat currencies, which depend entirely on faith. And it's as simple as that. So, well, where are we? I mean, I think we can really say that gold over millennia, basically, its purchasing power varies very, very little, and there's ample evidence of that. But when it comes to fiat currencies, they come and go. They don't last terribly long, is a short answer. I mean, the dollar has really been a fiat currency for some considerable time. I would say since 1933, if you like. Just before, they devalued it from 20.67 to $35 an ounce. But more specifically and more obviously, since the Bretton Woods Agreement was suspended actually, in 1971. So we've had 54 years of pure fiat currency. But the destruction process actually started earlier than that. So we just bear that in mind. I think really what gold is telling us is that we're coming to the end of that era. And, anyone who's left holding the fiat baby is, basically has had it. That's what's going to happen. So that I think is the background. But the interesting thing is that the Chinese, who are a bit old-fashioned over these things, they didn't have the benefit of John Maynard Keynes teaching them economics, etc. They came out of communism, if you like, with the belief that the capitalist system would fail. And of course, the failure of the capitalist system, would be through its currency. And so they started accumulating gold, really, shortly after Mao Zedong passed away. And I've got an English copy of the regulations dated 1983, appointing the People's Bank of China with the sole responsibility for managing and acquiring the nation's gold and silver reserves. And this is terribly important. It's important to know this. The second thing to know is that no one in China was allowed to own gold until it was legalized in 2002. And that was the point where the Shanghai Gold Exchange opened, which facilitated the delivery of gold to the public. So we had this period between 1983 and 2000 when the China state acquired gold. And so where did it come from? Well, we had a massive bear market between those dates. And not only that, but it was quite clear that quite a lot of central bank gold held in the West had actually gone out on lease, never to be returned. This was estimated by Frank Federosa to be somewhere between 10 and 14,000 tons. In other words, between a third and a half of all central bank gold was out on lease, sold into the market, and not coming back.
Macleod's research brings to light an important realization for private investors. Owning gold involves more than just keeping track of prices. It also entails comprehending the broader context of global power, influence, and economic strategy. Gold investors in the West who view it as a secondary or specialist commodity run the danger of falling behind. The direction of markets, on the other hand, will be quite clearer to those who follow Asian policy and gold accumulation patterns. Macleod cautions that failing to pay attention to these changes may result in lost opportunities or even unanticipated exposure to market volatility. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
And the other thing, of course, is that state-owned refiners were bringing in doré from abroad. I mean, particularly, obviously, Mongolia, and paying them for the doré. And where did the gold go? Didn't leave China. I mean, as far as the relationship between gold and China is that China is Hotel California. It comes in, that's no problem at all, but it can't get out. So that has been the policy. Why is it this policy? It's this policy because the Chinese understand the importance of gold. Now, since the SGE opened, over 27,000 tons of gold has been delivered into private hands. Now, some of that would have returned into the Baltic system as scrap. But I don't care because that just gets redistributed elsewhere. It's not going out of China. Never has done.
No.
And on top of that, of course, you've got the banks. The banks run gold accumulation plans for their depositors. And this gold is not delivered out of the Shanghai Gold Exchange. It is stored within the Shanghai Gold Exchange. So we don't know how much gold there is there. But I should think it's quite a lot. I pencil in a figure about 10,000 tons. Now, I think that might underestimate the situation for the very simple reason that household savings rate is in the order of, it's over 30%. And that's the equivalent of $5 trillion a year. Now, it used to go into off-plan apartment buildings and stuff. That's gone. Let's forget that. Stock market, maybe a little bit, but I think that's got very, very limited appeal. I mean, really. And then the other thing you've seen, I mean, mostly it's been accumulating as as deposits on the bank's bank accounts, deposit accounts. But for the last year or two, the People's Bank has been reducing its sort of main interest rates, and the bank's with it. And so, what does the housewife do? Well, the answer is that she opens a gold accumulation plan, which she can do for as little as 500 yuan. So that's, which is less than $100. So, this is actually very important. If you take this all together, we are, in my estimation, looking at a figure like 75,000 tons out of a total of a bit less than 200,000 tons of above ground gold stocks.
Yeah.
China has cornered the gold market. That's what it boils down to. Because it's not just China. You've got India, which has got massive amounts of bullion held in the form of jewelry. I mean, most of the Chinese public gold is actually jewelry as well. And you've also got Russia. Now, I understand on pretty good authority that Russia's got 2 sovereign wealth funds, which have a total of about 10,000 tons of gold between them. And then you've got the Russian Central Bank, which has got a further, 2.3 thousand tons, whatever. You've also got the whole of the Shanghai Cooperation Organization and BRICS, all their central banks. Presumably they've got sovereign wealth funds as well. Now, all this is meaning that the liquidity we have here is minimal. Now, let's look at the demand side. So far, this hasn't mattered because nobody wants to buy gold. I mean, any investment manager isn't going to earn fees by putting his punters into gold. He would rather put them into something which is going to pay him a bit more. And not only that, but the regulators are on his side. The regulators turn around and say that physical metals are not regulated investments. But of course, this was why they said they set up ETFs, to get around this regulatory hurdle. But the ETFs are beginning to grow. People are beginning to buy into them slowly. But the other thing, which I think is very important on the demand side, is that we now see analysts at the major US banks turning around and saying, we believe gold's going at 4,000, whatever their reasons. I don't care. I mean, they don't know what they're talking about. I reckon that's my default assumption anyway. But, the fact that they are saying it, and the fact that the investment managers within those banks, who are typically managing or responsible for over $1 trillion, we're looking at banks like Goldman Sachs, Bank of America, Citibank, Citicorp, whatever they call themselves now, etc. We're talking about huge numbers. They haven't got any. I don't think they necessarily know how to get it, actually. I mean, so that, this is interesting. When you look at the complete investment management universe around the world, it is estimated that portfolios are worth some $300 trillion. $300 trillion. Now, gold ownership of that, you just look at ETFs and maybe sort of make a few assumptions about, bullion being stored and so on. But, basically it's ETFs and nothing else. It's less than 0.5% of that. I mean, it really is. Less than 0.5% is in gold. And yet you've got these behemoths in America now thinking, we better buy some of this. Now, to put it into context, my China story suggests that the amount of liquidity, which is unspoken for, including jewelry in the West, is probably in the region of about 40 to 45,000 tons. That's all. That's it. We can see what's in the vaults. We can't see what's in the Swiss vaults. That's something I don't know. I would, someone gives me a number, it'd be super. But I think quite sensibly, the Swiss don't produce these numbers. That's what I would assume anyway.
According to Alasdair Macleod, some countries such as Russia and India have sizable gold reserves that are either the result of central bank stocks, private holdings, or sovereign wealth funds. About 10,000 tons are purportedly held by Russia's 2 sovereign wealth funds, while a further 2,300 tons are added by the Russian central bank. This significantly lowers the quantity of gold available to Western investors when combined with Asia's other holdings. On the demand side, Macleod notes that Western investment managers have always disregarded gold. Although they help get over regulatory obstacles, ETF adoption has been sluggish. Even big American banks like Goldman Sachs and Bank of America are now openly predicting that gold will reach $5,000 or more, indicating that conventional financial institutions are starting to acknowledge the strategic significance of gold. However, Macleod cautions that there is an impending liquidity crisis since these institutions do not completely comprehend how to get actual gold. According to his calculations, it would need 25,000 metric tons of real gold, much more than is currently available if just 1% of the $300 trillion global investment portfolios were to switch to gold. According to Macleod, this mismatch between the surging demand and the limiting supply is paving the way for what may be the biggest squeeze on gold markets in history. He adds that although silver's industrial use caused it to behave differently, the same concept of restricted liquidity still holds true. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.